Well, it's a great pleasure to be here. Thank you so much for the invitation. I just landed this morning and getting ready to go up the mountain tomorrow morning. But it's fun to be able to spend some time in Zurich. It's a fantastic city, and to get to share some of the insights from the work that we've been doing over a project that's really now lasted almost 4 years, actually a little bit more than 4 years. And so what I thought we might do today is I cobbled together a few slides from various presentations that I've made in the past, a lot of them drawing on insights from a report that we released at the end of August of 2017, and I'll walk through those, and then we can kind of have a bit more of a discussion. I know John prepped a few questions, but feel free, interrupt me at any time. It's a really small group, so let's sort of have a dialogue, and if anything sort of doesn't make sense or doesn't scan, just let me know. So, Fintech, it's this fast-moving space, right? And everybody is, it's on Twitter. I get 6 different roundup emails every day of all of the different sort of fintech deals that are going on, and it can be really tempting, I think, to chase the new thing. But I think it's always important to put things into historical context, and the history of fintech might not be that long, but I think about when we started, which was back in 2014, in Davos actually, we launched this initiative wanting to understand whether or not the types of disruption that we'd seen come to other areas of the world could come to financial services. And partially it was because, look, manufacturing, media, they'd all been disrupted. Maybe finance would be next. And also, I don't know if you remember 2014, but everyone was just deadly sick of talking about regulation and the post-financial crisis reconstruction, that we thought, we got to talk about something else. And I was a little bit surprised because in spite of all of the changes that had come post-financial crisis, financial institutions' vision of themselves, with this group of 50 bankers, insurers, and asset managers, all of them C-suite, was really unchanged. They viewed themselves as institutions, central pillars to the world of financial services and to the broader really running of the macro economy. And when I asked them, are you guys worried that these new peer-to-peer lenders or robo-advisors are going to disrupt you? They said, no. We've got scale, we've got the trust of our customers, and we have got regulatory complexity like you wouldn't believe. I've never heard a group of bankers speak so glowingly about the regulator as in the context of this question of whether or not they could be disrupted. But as you'll all remember, if you left the boardroom and went to Silicon Valley or to Shoreditch or certain cooler parts of Singapore, you would hear a very different story. You'd hear a story about how banks were the blockbusters of the future. They were dinosaurs, and that these new fintech upstarts, few folks in a garage were going to upend JP Morgan and emerge as the new titans of financial services, making the world a better place along the way. And so we thought, well, this is an interesting contrast. And if we just talk to our traditional constituents, the large financial players, we're not going to get a square view on this. So what we really needed to do was to leverage the forum's convening power to try and bring a broader view of what was happening in financial services. And so over the course of the past 4 years, we've done interviews with over 500 subject matter experts from across fintechs, incumbents, and academics and regulators. But most importantly, in almost 30 workshops now, we've brought together relatively equal numbers of fintech innovators, senior executives, regulators, and policymakers, and basically asked them to fight it out on their vision of the future of financial services. And so I want to talk about 2 things this evening. First, I want to talk a little bit about where I think financial services is today. Where are we in the fintech revolution? And what does that mean for where we are moving forward? And I think one of the interesting things is that if we take a step back and we're really honest with ourselves, a lot of the fintech narratives that were spun in 2013, 2014 have fallen short. You may or may not have noticed, but two guys in a garage have not replaced JP Morgan or UBS. And indeed, while now it might be more possible than it was before to run most of your financial life on a series of apps and fintech startups, the practice is that very few people actually do that. I have lived and breathed fintech for the last 4 years, and I don't actually use a lot of fintech products. In 2014, when we kicked this off, there was this narrative that Apple Pay was going to utterly transform the payment space. Today in the United States, 6% of iPhone users are monthly active users of Apple Pay. And so if a company that has the breadth and user engagement of Apple can't get people to change, well, what does that mean? But as we looked back at the structure that we had created when we first kicked off this project, we built this taxonomy, if you will, of the innovations that we were seeing in financial services. Where were the important innovations happening in various product groupings? We began to see something interesting, that while it would be easy to say that fintech players have not transformed the competitive landscape. Don't get me wrong, there have been unicorns built, there have been niche players like TransferWise and Stripe that have found areas where they've been able to build huge businesses. But in practice, they weren't disrupting the competitive landscape. But if you think about the way in which the dialogue in any of the slices of this pie have changed, what you started to realize was that fintech players were dominating the innovation conversation, that they were at the forefront of defining the pace and the direction of innovation in financial services. Take, for example, something like lending. So in the United States right now, peer-to-peer lending, it's not even really peer-to-peer lending, it's marketplace lending, is an utter mess. What a lot of the marketplace lenders have discovered is that the funding dynamics, the cost of funding for what they're doing just doesn't really work out. Balancing the marketplaces and accessing stability of funds has been enormously challenging. But who has defined the gold standard for the user experience of an individual looking for a sub $10,000 consumer loan, or a small business looking to access an unsecured line of credit? Who has set the expectation that you should be able to do that at 3 a.m. from your computer in your underwear? It's been the fintech innovators. And there's a real sense in which the incumbents have found themselves forced to respond to the standards that fintechs have laid down, even if the fintechs themselves have experienced serious challenges in terms of achieving scale under those models. I think a great example of this, perhaps the best example, is in the robo-advisory space. So I remember when I kicked off this project, one of the first discussions I had was with a guy named Bo Liu. Bo ran a company called Future Advisor, the third largest pure play robo in the United States. Brilliant guy. Clear vision for what the future of mass and mass affluent wealth management looked like, particularly for younger cohorts. I said, Bo, this is a great concept, but what's to prevent the incumbents from doing this themselves? He said, well, you know what? They just don't get it. The technology's too far behind. We're going to get out ahead of them, and we're going to beat them to the punch. Now, 4 years later, Bo ran out of venture funding, got bought by a small outfit called BlackRock, who is now using that technology and white labeling it. The largest pure play robo in the United States is Betterment, which has now a little over $10 billion in assets under management, as well as owning the top of every cab in New York City, where I live. really aggressive marketing push, really high cost of customer acquisition. And they've been at it for well over 5 years now. By contrast, our friends at Vanguard, they started their robo-advisor about 2 years ago, have about $70 billion in assets under management. And so I think this is, in a sense, the perfect example of how we've seen the dialogue in this space change. From David versus Goliath, will a fintech overtake the incumbent, to fintech and incumbent ideas and capabilities merging together. The scale, the customer relationships, the existing engagement and KYC that incumbents are able to bring to bear, and the capabilities, the innovative new ideas, the customer-centric approaches of the fintech. And so you've seen this world in which partnership has become absolutely a watchword for the fintech dialogue, and it has been for a little while now. And you see partnerships evolving under multiple frameworks. You see pure B2B players. RegTech is often discussed here, devising niche point solutions to really significant challenges that exist within incumbent organizations. A London outfit called Fundapps that I'm particularly fond of, who has really taken the holding disclosure requirement space and devised a really effective solution, because what we see over and over again now is that large institutions are looking to take a lot of these non-differentiated, non-competitive areas and figure out ways of moving them out of the organization, ideally to providers who can give them a kind of scalable, almost cloud-like experience. We're also seeing that some of the some of the big B2C players who were looking to disrupt the incumbents are now saying that at least part of their business, they want to be in servicing B2C. And you've seen a lot of discussion about OnDeck and their small business partnership with JP Morgan, taking aspects of their origination and their adjudication technology and feeding it into a business that at JP Morgan has traditionally been small relative to the size of the organization as a whole, and helping them to expand that book of business, ideally to the benefit of both. You're also even seeing instances in which partnerships are happening between incumbent organizations, where institutions are saying that there's a particular thing that they're very good at, and that they want to have that be a capability that they outsource to third parties. BlackRock and their Aladdin suite of services, I think, being a fantastic example of that. Once upon a time, the idea of giving your risk model to someone else would have seemed insane. Now, Aladdin runs something like 15% of all the world's assets. And Larry Fink has said that he wants to grow it from right now being about 7% of company revenues to 30% of revenues at some point in the future. And I was speaking earlier about cloud and cloud-like experiences with Fundapps. There's also the cloud, and the fact that having flexible IT infrastructure, incredibly important. I think it's remarkable the shift that we've seen in the dialogue around this. I had a number of CEOs that I spoke with early on in my project back in 2014 saying, we will never in a million years go off-prem with our processes or data. It turns out that it was 3 years, not a million, but not to get too fussy about the details. And so all in all, what we're seeing, in my view, is that financial services is becoming more modularized. And so institutions, particularly incumbent ones, are able to select pieces of their business and to move them out. And particularly for non-core processes, this is allowing a reduction in cost. It's allowing them to stand up new capabilities more quickly. It's allowing them in many ways to treat the fintech landscape as a supermarket for capabilities. And so you might be thinking right now that I sound like I'm a shill for the incumbency, that this is a story about how really there are no problems for large financial institutions. It's good that they all set 2016 as their as innovation being the priority, but now that's done and they can kind of go back to business as usual. And in fact, I think that nothing could be further from the case. And my view is that this shift that we're seeing to partnership and to an increasingly modular environment is transforming the broader landscape of financial services. And so it's not about bank versus fintech, it's about both of those institutions, or both of those types of institutions, figuring out a way to navigate a shifting landscape. Because if we look to the future, what does a more modular environment mean? Foundationally, I think that modularity means that you have new battle lines being drawn for financial institutions, because you are effectively able to break down old structures and recombine them in new ways. And my favorite example of this happening right now is in the insurance space. So there's all these really cool insurers, and I think InsurTech is one of the most interesting spaces, because you're really having people designing like totally new kinds of products. Trove is this cool Silicon Valley outfit that lets you insure individual items and sort of turn on and off the insurance. When do you want your bike, for example, to be insured? Bought by Many is this basically allowing affinity groups to form themselves, and so it turns out that pugs are often excluded from pet insurance, but they let pug owners get together and negotiate for rates on pug pet insurance. And then everyone's talking about Lemonade. I don't know about you guys, but every YouTube thing that I watch has a Lemonade ad in front of it right now. Right now they're doing renters insurance, but there's sort of I would say a consensus that it's first renters insurance and then the world, and they're adjudicating rather originating policies in half a second or something. It's a pretty remarkable system that they've built. But you might be excused for saying, like, Jesse, this isn't some like social solve the brunch problem payments app. This is insurance. I need to know that they're going to be able to pay when my pug gets sick or my bike gets stolen. How do we know that they're not just going to run out of venture capital funding? Well, it turns out that they've all three of these have received significant funding from and have insurance backing from a little-known outfit called Munich Re. They've only been around for 100 years or so. And you might ask yourself, well, why is Munich Re investing in all of these Silicon Valley companies? Well, my take on it is that Munich Re has a vision of a transformed landscape for insurance, one in which these insurtech players are important originators of policy, and one in which they are able to cut out the carrier from the insurance process. And that means that Munich Re, who's had sub 10% growth for the last decade and a half, suddenly has an opportunity to get a larger share of the pie through a collaboration with these insurtechs that effectively cuts the middle out. And so my view is that if you look at different products and services across financial services and think about the ways in which the value chain can be reorganized, that you're going to see new battle lines being drawn in all kinds of different areas. Market infrastructure, I think, is another really interesting example here. You're seeing today execution facilities like exchanges and clearinghouses looking at all the data flowing through them and saying, we have to build a business on monetizing that, while at the same time the data providers, your Bloombergs and your Thomson Reuters of the world, are thinking about how do we expand into the execution game. And in both cases, they're going to look to the fintech ecosystem to be key enablers of them deploying those capabilities. I want to dive before I finish up into what I think is the single most important trend in this restructuring of financial services. And that is something that I elegantly called the multi-provider platform. Really rolls off the tongue. But it's the idea that the way in which financial services gets provisioned might be changing, because we're pretty used to the notion of financial institutions being pretty heavily vertically integrated, that the value chain is sort of owned end to end by more or less the same institution. And I think there are really compelling reasons from the customer perspective to want that to get broken up. I love this example. So there's a company in the United States called Intuit. They produce something called QuickBooks, which is a really extensively used cloud-based accounting software for small businesses. They're a similar outfit to Xero and a number of other players. And they've been thinking about how they can get involved in the financial services space. And it might seem a little bit odd, but then you reflect on the fact that they have access to all kinds of data about your business. Seasonality of products, concentration of suppliers, what's the range of products that you deal in, et cetera, et cetera. And they're now providing a service to their customers. They package up that data, but they don't adjudicate on it. They don't have any desire to go into the business of being a lender. No. Instead, what they can do is package it up and send it off to many different providers of capital, get responses from those about the terms under which they'd be willing to extend a loan or revolving line of credit, filter through them, pick the best 3, and present them to you directly in-app. There's no going to the branch. There's not even any going to Google and looking for a loan and sort of typing your details into a number of different places. They have curated for you lending opportunities, originated them in-app, and certainly could have the potential to expand it into the servicing of that loan automatically through the app as well. And so you start to see this world in which there are 2 types of entities. There are the platforms for the origination and the recommendation of financial services, and there are the providers, the heavily regulated institutions providing capital, making adjudication decisions. And I would argue that depending on where you fall in that divide, you are going to face in the future very different financial imperatives, very different competitive imperatives. Let's think first about the manufacturer. So if you are manufacturing loan products for sale through the Intuit platform, well, then you can't cross-sell once you've acquired the customer because you didn't really acquire a customer. And moreover, you can't cross-subsidize certain products. And this is, these are cross-subsidization, cross-sell. These have been absolutely core to the KPIs of financial institutions, large retail institutions for over a decade now. Suddenly, I would argue that you have a lot more in common than you used to with the app developer. Because what matters to the app developer? What matters is how do they figure out how to get themselves in that banner, in that editor's curated picks, games you would like, super productivity software, our best picks, whatever it is. So effectively, suddenly, you need to figure out how you are going to get search engine optimized to have your financial product put into the hands of the customer. That's a real shift in competitive dynamics, and in my view, it has the potential to drive towards a bimodal distribution. On one hand, you have low-cost players who will inherently be very large scale. I think you've seen this to a degree in the wealth management space where players like BlackRock and Vanguard have been able to take their scale and use it to deliver really, really, really low-margin products. On the other hand, you'll have players who are able to provide niche curated products that really are the best fit to certain subsectors of institutions or individuals who were being underserved in the past, which sounds maybe like the kind of thing that a fintech might be more disposed to be able to do than a large institution. And so if you're a mid-tier player, this is potentially a really challenging eventuality for you. If you're a fintech, it's a huge opportunity to potentially to achieve scale. And so maybe you say, oh, okay, no, I don't like the way this manufacturing space is looking. I want to be a distributor instead. I want to be the platform. That's the sexy stuff. Be more like a Facebook or a Netflix or something. Netflix is straddling both sides these days. But I think one of the interesting things that you see there is that for traditional financial institutions, this is even more of a jump. Because in my view, in the platform, customer centricity becomes absolutely essential. And the vast majority of large institutions today, despite enormous spending and real effort, remain largely product-centric. And so if you want to be a platform, it requires a transition to being centered around data, not just financial, but data of all kinds, social, locational, contextual. And it requires the ability to analyze and make constructive recommendations on the basis of that. One of the best things that I've read in the last few months is a short blog post by a partner at Greylock called The New Moats, in which he talks about the idea of building a platform of experience where you're able to aggregate all of these different pieces of information and to create, based on that, a platform of intelligence, wherein the recommendations that you're able to build on the data create barriers to exit for clients. Because why would they leave when you, who know so much about them, who are able to recommend these perfect products, are able to do that at a much better level than others? And so I guess where this leaves us is that whether you're going to be a product manufacturer or a product distributor, I think it's going to require for incumbents new capabilities. And that's where one of the interesting tensions comes into play, which is that in order to acquire these capabilities, you can either build them or you can buy them. And building them takes a long time. It almost certainly takes too long, and things like cloud computing are inherently very scale-favoring industries, or very scale-favoring operations. And so, in my view, increasingly, there will be a need to partner with large technology organizations who are really excelling at things like cloud as well as general AI. No doubt there'll be financial institutions who are able to make real advancements in terms of the delivery of financial-focused AI, but I mean, the notion that a financial organization is going to be the one to develop the killer chatbot or the killer day-to-day recommendation software and Q&A software that people are going to be looking for, that's a little bit more of a stretch. And so the challenge becomes, how do you bring into the organization the partners that you're going to need to acquire these capabilities without exposing too much vulnerability to them? Because I think that the question that bankers have traditionally asked in this space is, what if Google becomes a bank? What if Amazon becomes a bank? Well, the question in the multi-provider platform world is the wrong question, because it's not about them becoming a financial institution, becoming a fully regulated, fully licensed creator of loans or funds or any of these other things. No, it's about more of a brokerage story. It's about an experience layer that's certainly licensed to handle financial data and to originate or distribute financial products, but that doesn't necessarily do all the work of maintaining those or actually creating them. And that, to my view, is a world that could be much more appealing to large technology companies, as it fits much more directly to their strengths. And so while we've been talking for ages about the potential of big tech's entry into this space, I think that the chances of it today are fundamentally different and fundamentally higher than they have been in the past. The interesting thing for fintechs is that either way, it could be a win. Whether it's banks succeeding in becoming platforms that are more open to partnership and data, or whether it's the big techs looking to do the same, there'll be opportunities for fintechs to integrate with each one and to effectively hitch a ride, I think, on achieving scale, assuming that they have a good understanding of where they fit in a broader ecosystem and don't necessarily try and build the entire ecosystem themselves. And so I think maybe let's wrap it up there, and we can kind of have a little bit more of a discussion. Nobody interrupted me, which either means that you're bored stiff, very polite, or we're going to skip by these, or just don't have any questions.
Jesse and I are both Canadian, and aside from being funny, that also means we're very polite. Swiss are almost as polite as Canadians, almost. It was great.
I don't want to get into a fight. There's more of them than there are us.
That's true. So we were talking actually before we got started this evening about platforms, and it was great to hear that theme running throughout. I'm sure we're going to pick up that a few times. What I wanted to start off first of all was really the reason you're here in the first place. WEF. Platforms, I guess, isn't the only topic there. What are some of the themes that you can maybe preview are coming up this year at WEF?
Yeah, and I think it's interesting because I think platforms is a kind of a nuanced idea, but it's also an idea that lives sort of deep in the ops of an organization, which isn't always the sexiest topic. And so I think that there's a sense in which you won't see at high profile too many discussions about PSD2 likely or the broader open data movement on the main stages, but I think in the discussions that people are having around the village, I think you're going to hear a lot about figuring out the right responses to that strategy and making a shift. I think there are two topics that, at least for me, are kind of feeling like they're at the fore this year. One is that I feel like this is the year that everyone is going to talk a lot about artificial intelligence, particularly in financial services. I don't necessarily know that means that anyone knows what artificial intelligence is. Well, no, we'll get there. We're going to put that AI on the blockchain. I actually did. I have had an ICO marketed to me through Facebook for the first AI chatbot on the blockchain, which I felt like it was a really amazing synthesis of buzzwords. But I think it's interesting. I think that there's a lot of disagreement about what AI means, and a lot of people run around trying to define it, and whether you're coming at it from the perspective of a technological school of thought, or you're deep in the ops of the organization, or you're taking a more strategic context, I think it means very different things. I think for us, and we've been running a new project on it for about 5 or 6 months now, it's really about changing the constraints that financial institutions of all kinds are subject to. And I think particularly interesting in that space is that the ability to substitute capital for labor opens the possibility for mass customization of both retail and commercial products. And I think that's a theme that we're really going to push on in a 50-person workshop that I'm running. And also the ability to sort of perceive signals that would not otherwise have been perceived. And so we're going to be digging into really what that means, as well as the much less glamorous sort of story of what just being able to automate what continues to be, as crazy as it seems, a paper-based set of processes within financial institutions, where that creates big opportunities in today's low-margin environment. Mm-hmm. The other is blockchain. Right? And blockchain continues to be a big issue, and here in Zurich, you're sort of right on the doorstep of / in one of the blockchain hotspots. I always reflect on the fact that I think the blockchain conversation has gone through a number of different stages in its evolution. First, you had the what the hell is a Bitcoin? People sort of being like, this thing's really weird, let's take a look, it's kind of curious, it's kind of ingenious, and a lot of bankers saying this just isn't really fit for purpose for us. You then had what I call the blockchain as infrastructure stage of the dialogue, in which people said, there's something really interesting here. Maybe we can use this to retrofit all of the aging infrastructure we have and to deliver new capabilities. And some people will call this blockchain, not Bitcoin. And I think you have ongoing a lot of work in this space, but surprise, surprise, building financial infrastructure is not an overnight endeavor, and it doesn't just take technological innovation, it takes significant stakeholder alignment. And that stakeholder alignment isn't something that you can achieve through the blockchain. It's a very sort of messy and human process. And so I think it's still going to be a while until we see a lot of the potential value there realized. And there will likely be projects that fail along the way or end up just not having been fit for purpose to a blockchain solution. And that whole dialogue, down in the bowels of the organization has now been kind of overtaken by the, oh my God, why didn't I buy a bunch of Bitcoins part of the conversation. We've seen this explosion in valuations. We've seen an explosion in the number of assets with a lot of ICOs, many of which happening right on your doorstep here in Zurich. And it's triggered, I think, an interesting phase, which is that it used to be that people were talking about blockchain, not Bitcoin. Now you have people who want Bitcoin but not blockchain, which is to say you've got a lot of people who want to own exposure to crypto assets, but who want to be able to call their broker or the digital equivalent thereof and get it. They don't want to have to manage a cold storage crypto wallet or buy ether so that they can then acquire a token and figure out what the hell a SAFT is and all of this sort of stuff, right? And so I think one of the questions that we're starting to see asked is, what does this mean for the connectivity and the risk of contagion between traditional and crypto markets? And what are best practices to ensure that the high volatility and sort of fundamentally different functioning of crypto markets does not create undesirable disruptions in traditional markets. And so you see that obviously being considered in the fact that the CBOE's margins on Bitcoin futures are very high, 50% if I'm not mistaken. And you see prudent measures being taken, but I've seen an uptick in the desire to have dialogue about what best practices for forming good relations between the traditional and the new infrastructure.
Yeah, I want to make sure I'm looking up because I'm listening quite intently. Any questions at this point from the audience while we're talking about the Bitcoin subject? Because I can keep going here. Okay, regulation is one angle to Bitcoin I was curious about, and WEF would seem to be one of those places that would be well suited for the type of dialogue that needs to be had. You hear a lot of governments saying this is beyond our borders, we can't really handle it. WEF is a global meeting place for governments and industry. What's the consensus or what's the atmosphere there around the regulatory questions around blockchain and Bitcoin?
So I think first, let's take a step back and think about this more broadly. I think that if you went back to 2014, one of the things that I heard over and over again was like, oh, the regulators will never allow any of this. They got spooked by 2008, and in being spooked by 2008, they're going to want everything to be centralized with heavily regulated financial institutions. And indeed, I think it's now manifestly obvious that that was a misinterpretation of the regulators' objectives. I think particularly if you look at venues like the UK, where the FCA has used their mandate to drive competition to actually encourage the development of fintech. You've seen across the board regulators engaging in what some might call strategic competition to attract and acquire innovators. I think that furthermore, you'll see that a surprising number of regulators are extraordinarily interested in blockchain, both as infrastructure and as a new asset. But that generally the view is that the problem is not with the operations, but the question of whether or not there is actually a need to do things in new ways. Okay. So if you think about clearing and settlement, there's nothing wrong with moving from T+3 in the United States. It's a little embarrassing that it's still T+3, but whatever, to instantaneous. And the regulator isn't opposed to that, but that doesn't mean that there aren't regulations in place that need to be changed. On the other hand, ICOs, does the regulator feel that the public interest would actually be served by removing the requirement for equity registrations? My supposition from the discussions that I'm having is that they don't feel that there is actually a need to change there. And so I think one of the ways in which the crypto environment creates challenges for regulators is that things often don't fit well into buckets, and something will have properties of a commodity, properties of an equity, properties of a currency, but that foundationally I think that the differences are not actually about technology often so much as they are philosophical differences about what ought and what ought not be regulated.
Right. Maybe changing topics a bit and also scales here. We've talked a bit about what it takes for companies and startups to work together well. I wanted to kind of zoom out and look at the international perspective of things. You're flying around the world. You've talked about a few of the fintech hubs that are out there these days. What are you seeing in terms of countries and in particular these financial clusters adapting to the new realities of the fintech ecosystem? Are there examples that are really worth taking a look at, best practices that are out there, any particular things to watch out for, countries need to avoid?
So, I think one of the interesting things is that I think we are in the midst of a divergence in operating models for financial services. We talked about this a little bit in our report, and it's been picked up and discussed in a great deal more detail in this month's edition of The Banker. I did a great article on this. But in my view, if you look at China, if you look at Europe, excluding Switzerland for the purposes of what I want to talk about, and you look at the United States, you have the emergence in those areas of very different financial operating models. China, the Wild West in many ways, rapid growth of fintech, and the emergence of platform players. I think really the most mature platform players for financial services today are Ant Financial, Tencent, and maybe you could include JD.com in there as well. And you have there a banking stack that is almost end-to-end technology company, wherein the technology company that wanted to create a money market fund that we now know as the Yue Bao went and found a little-known asset manager who went and built it, and now it's so large that the PBOC, as I understand, has asked them to stop taking new funds because it is too disruptive to the interbank lending market in China. Here in Europe, though not here in Switzerland, my view is that PSD2 and open banking more broadly, and you'll see that in Australia, and there are a lot of people talking about it coming home to Canada as well, that it creates the opportunity for a division between tech players running the front end of the experience and traditional financial institutions who have the regulatory licenses and the know-how for product creation to sort of sit on different sides of the equation. And then in the United States, where open data is nowhere on the agenda, you don't have that ability for a third party to come along and draw data out of the financial institutions. So setting up the marketplace is a little bit more difficult. And what I think you'll see instead is this walled garden approach, wherein you have large financial institutions picking and choosing partners and sort of creating curated ecosystems of partnerships in an attempt to differentiate themselves from others. And so you're seeing this diverging operating landscape driven in part by different customer bases and in part by different regulatory environments. And while I think in the past we've often viewed the evolution of financial markets as a straight line process, we're actually seeing this sort of forking of the roads. It'll be interesting to see how those economies work together as they become more difficult, and it will also be interesting to see how in emerging markets, think Kenya or a Malaysia, they'll, to a degree, have a choice as their markets become more financially included on which operating model they want to pursue.
You left out Switzerland when you mentioned Europe. How do you see, let's say, smaller financial centers or ones that have a positioning like Switzerland in that new type of landscape?
So I left out Switzerland because, if I understand correctly, PSD2 and open banking haven't been enacted here. I mean, based on that, I think that from a retail perspective, you're likely to see an approach that looks more like the US model, this curated walled gardens, people looking to local partners who understand the sort of unique needs of Swiss customers and building those around them like Lego blocks almost. I mean, I think the bigger challenge in Switzerland, and I'm not telling any of you anything that you don't already know, is that there is this bigger challenge of the future of private banking and private wealth management, and what is a sustainable model for it moving forward. I mean, I am not of the inclination that robo-advisory is going to be built at a sufficient level of capability that it serves the needs of ultra high net worth customers. There are sufficiently few of those that it is not necessarily necessary to build them out. But I think at the same time, it's clear that it will be necessary to use technology in new ways to serve the needs of customers. Sometimes that'll be really simple stuff. There's a company based out of Austin, Texas, called Live Oak that's doing some really interesting stuff around bringing together video conferencing, electronic signature technology, and sort of Google Docs style document collaboration to rapidly accelerate the pace of rollovers, and it's allowing companies that use it to really sort of rapidly acquire new clients and to move people away from advisors. But I think that, and I'm not an expert on private wealth, but there's a general recognition that the model needs to transform, but it's not clear what the future state looks like.
Yeah, that's a big thing here in Switzerland, and we've heard it for years, the whole skepticism around AI or robo-advisory. How do you see the dialogue around the other major industry here, insurance? It popped up once or twice in your discussion, maybe even contrasting it to, say, the banking side, because that's usually what we're talking about, right?
Yeah, and I think it's an interest. So my thoughts on this are relatively fragmented and unconstructed. I'll give you like a couple of ideas. So I think that there is an obvious and currently seen push to scale in insurance. It's driving consolidation, margins are low. There is a trend of demand destruction in insurance. The overused example of this is the driverless car. The driverless car simply does not need as much insurance because it's much safer, and so you have all of these sort of core premium areas that are not overnight, but slowly over time disappearing. And so with that, you're seeing insurers make a transition to new areas of risk, cybersecurity being viewed as a sort of a core area that insurers need to get good at both assessing those risks and selling the policies. Looking a little bit further into the future, a couple of trends that I think will be important. One of those is that if we think about breaking up that value chain, think about underwriting. Now, most insurers would say that underwriting is the beating heart of their organization. You have a few that are more centered around like customer service and claims processing excellence, but let's look at the ones who look at underwriting. If underwriting is the core of your business, then maybe you're willing to let someone else handle aspects of distribution. Increasingly, capital markets are becoming very fungible around insurance, and so you have the ability to access capital in new ways. Maybe where you really want to focus is underwriting. But what is underwriting? If you ask a traditional insurer, they view it as being a set of math skills, a set of analytic capabilities. But in my view, increasingly, the ability to have cutting-edge analysis is about the ability to feed complex models with data. How will you acquire the data streams for that? I think that's going to require partnerships, and you need to start to game through in any given product category what the partnerships are that will deliver that data to you and whether or not you're going to be able to get them. Because if we go back to automotive, the automotive manufacturer will have access to a level of nuance and data about their product that no one else has. Uber will have a level of understanding about the unique risks that an Uber driver has and how they are different than a classical driver that no one else has. It's an excludable data set. The analytic capability is becoming progressively more commoditized. I think this drives us towards a world in which more and more manufacturers of product and services bake insurance into the cost of their product and self-insure. Now they'll go and they'll get a reinsurer to cover their risk on the back end, or they'll go get a cat bond or some other sort of insurance-linked security to make sure that they don't have an unlimited exposure. That's a fundamentally different equation from the one they have now. So what do you do as an insurer? You need to offer a differentiated value proposition that's about more than just cover. And so our view is that it's likely that you will see more and more insurers looking to move into advisory. Now, we've traditionally thought of advisory and insurance as being a high-end service that you give to complex clients. But imagine the way that AI, or just the ability to sort of automate recommendations, allows you to, for example, give people advice on which road to take, or when they should, close the windows on their house, or, close the storm shutters because there's some incoming storm, right? Advisory that helps you prevent. And over time, as we start to think about IoT becoming more and more integrated into our lives and our homes, actually the insurer taking active steps to prevent risk. So it's not just that your insurer covers you if something bad happens, they prevent the bad thing from happening. And so that's, I don't know that we'll actually end up there, but that's one model that we're seeing more and more insurers seriously exploring.
Very interesting, the whole the cyber side and then also the data side, to hear how that's moving. So thanks for the insights. We talked a little bit also in the discussion about the build or buy decision, and it actually brings back memories of when I was looking at robo-advisors for one of the Swiss private banks, and I summarized all these nice profiles with a little button that said basically build, buy, or copy basically was the other option. And most of them were copy. Build. Beyond build or buy, what do you see as some of the new capabilities that companies really need to master, or to put it another way, the leading companies are mastering or differentiating themselves with?
So I was in Australia in December talking to a bunch of the banks there, and the Australians are very, very far away. If you've flown there and you realize that you think they're near Hong Kong, but it's a 9-10 hour flight, they are very isolated. And so the first thing that every banker I sat down with and every insurer I sat down with asked me was like, who's really doing this right? And I had to tell them I have no idea. Because even though I spend a lot of time poring over data and talking with senior executives from institutions, it's really difficult to tell whether something is an artifice on the surface or a core technological and organizational change. Technology is obviously an important part of this. The ability to and the capability to stand up new products, to make changes to the organization, to integrate partners rapidly and effectively. But just as important is operations. Because I think if there isn't a clear vision that's really set at the top of the organization, what we see over and over again is that ideas are given lip service but not fully executed. And so I think that's ultimately what it breaks down to. It breaks down to a need for a strategic vision for the organization and the ability to drive the change management of that transformation being really critical. And I think that build or buy decisions ultimately flow out of that. But if there isn't actual commitment to them, or if there isn't an understanding about how they fit into a broader whole, then you don't necessarily see impact over the long term. And I think the real risk I think that financial institutions are well positioned to be an important part of this space, but that there's a risk that they wait until the wolf is at the door, if you will. And if that happens, then the time that they require to catch up from an ops and a tech perspective is just too long.
One last question comes to mind. To what extent do you think that this is an industry question or a public sector question, the fintech dialogue? Again, something that I think WEF probably is well positioned to comment on, right?
Yeah, and I certainly wouldn't want to speak for organizational policy, but I think broadly speaking, that part of the ethos of the forum is that there is no such thing as a private sector question or a public sector question. Right. All questions have both dimensions, and I think we really try and take a broad view of this transformation, about thinking about on one hand, how competitive dynamics are evolving, but on another hand, about how we can take steps to ensure that the transformation of financial services is serving customers and that it's driving us towards a fairer and more stable financial system.
And maybe one cheeky question.
Oh dear.
WEF is definitely an influential event throughout the year. We've talked a lot about Bitcoin and blockchain. If you were to flash forward 2 weeks from now, do you think that WEF will have, let's say, helped improve the momentum for Bitcoin, or do you think you'll see it, or let's put it this way, do you think you'll see the momentum going up or going down post-WEF?
Oh, I mean, depends.
This is not trading.
I think that 2 weeks from now, the answer will probably be that it'll be both, depending on whether it's morning or afternoon. It's such a volatile asset. I mean, I think that there's a lot of attention focused on it right now, and it's really hard to tell where it's going to go.
Well, we're looking forward to the information coming out of WEF next week, and thrilled that you could come and give us a preview. I'm all out of questions, so I'm going to wrap up my part, but we are going to be here on stage for a couple of minutes. If anybody wants to throw a few more up for Jesse while he's here.
Thanks.
Peter.
Yeah, we touched on Asia, and I'm quite interested in China and India. And there's a lot of dynamics going on there. The few billion people that live in those countries are driving things much more than the people here in Switzerland. We're much more conservative, much more careful about things. But in India and China, you've got this fantastic movement from the youth in India, and from people who are behaviourally, using online sources and driving fintech. How can Switzerland, and thinking also about competition in Singapore, I'm talking about competition, how can Switzerland really sort of stay ahead of all this, so that really we keep all the know-how and the innovation here? We're number one in innovation here in this country, but it really needs to stay here as well. Switzerland, Europe. How do you see things, moving in that direction?
Maybe to just recap the question, how
can we stay ahead in innovation, bearing in mind that there are external drivers and forces coming from Asia, particularly from India and China?
I think that's an interesting question. I think the high-level answer is that I have no idea, and particularly I think this question of national strategy is not one that I'm necessarily well positioned to answer. I think that it's interesting if you look at, I don't know the Indian market nearly as well, but if you look at China, there certainly has been a different approach to regulation there. There has been a tendency for the regulator to let new concepts run forward, and then to as the sort of the challenges associated with them become clearer, and the disharmony, if you will, that they are able to create, then to see those progressively get reined back in, and you see this sort of give it a little slack, tighten it up iteration happening. I'm not sure that is necessarily a model that ought to be followed in other environments, because in China, one of the fundamental differences, and just generally in emerging markets, one of the fundamental differences is that you are not talking about making marginal improvements on existing products. You are talking about being able to deploy transformational improvements. I talked about Apple Pay a little bit earlier. Only 6% of iPhone users in the United States use Apple Pay. By contrast, mobile payments have been transformative in China, and that you now have I think 600 million WeChat Pay users, 450, 500 million Alipay users. Part of that is because they didn't have to make a choice between whether they wanted to pull a credit card out of the wallet or a phone out of the pocket. They made a choice between using cash and using a much more efficient means of payment. And so it's in a sense not fair to make the comparison of how can we achieve that level of growth, because there's just not the opportunity to make 100x transformations in developed financial markets. And the fact that there are existing products and services actually creates significant switching costs. I mean, to get to your question, though, about how do you drive innovation, I think that what you end up with is a situation in which the challenges of the European market and Switzerland more particularly are just fundamentally different from the challenges of the Asian or the Indian market, or the Indian or the Chinese market. And so as a result, there are new opportunities, but also new challenges. That is not a very satisfying answer. I apologize. I mean, and I think it's a bit of a motherhood and apple pie answer, but I think for a place like Switzerland, in my view, being competitive around financial innovation will ultimately be a cluster strategy. It will be about, Crypto Valley is a good example of a kernel of something that could be a cluster if crypto becomes a more dominant force. There is an existing cluster here in wealth management and in private banking. There's just a need to figure out what the next generation of that cluster is.
Yeah, one we like to talk about a lot is the reimagining of banking secrecy. You talked about data centers and the platform and the data hub, and perhaps that's another angle that Switzerland could really be focusing on in the future.
Yeah, and there's an interesting piece there around, I have a view of, sorry, 1 second, Julian. I have a view that data exchanges are going to become more and more important, and there may be interesting opportunities for Swiss as a trusted brand in secrecy, amongst other things, because as well as combined with the work that's being done here in crypto and zero knowledge algorithms and the like, that I think that there will be increasingly appetites for people to bring their secret, their excludable data together and to jointly acquire the aggregate insights of it without having to actually share the granular data with one another, or even to have to trust the institution in the middle. And so I think there are potentially some really interesting opportunities in that space.
Yeah, maybe thinking of crypto more in the sense of cryptography and how do you make trusted connections as opposed to decentralized or something like that. I think that really becomes quite interesting for Switzerland. And an angle we talk a lot about is convergence. So looking at how that data and that financial knowledge or that platform type of a position you can play can help to play this convergence that's expected in coming years.
Yeah.
Great, thank you. Next question, Julian.
No, it's just something to add. I think there's also a difference between innovation and entrepreneurial activity. And the way that innovation is being measured helps Switzerland a lot to be on top. So it's patents, academics, etc. So I think Switzerland, in terms of innovation, is well positioned. It could do a lot more for entrepreneurial activity.
Excellent question. Was there another one on this side I saw earlier? No?
Yeah.
And I'm slightly blinded. Did anybody in the back have a question for Jesse? No pressure. We can also break down and have a few drinks as well. Okay. Great. Well, thank you, Jesse, for joining us this evening. It's been a real pleasure.
It's a real pleasure.
He's come all the way from New York today, so a little bit of jet lag and good excuse to come and hang out further.
Unwind a little.
Thanks again, Jesse.
It's a real pleasure. Thanks so much.